Hi, good morning. Welcome to Saxo's weekly market outlook call. We'll just give it another few seconds for more people to join in. Okay, let's kick off. Hi, I'm Charu. I'm a market strategist with Saxo's Singapore office, and big week. All eyes on FOMC, but that's really not the only thing this week. Actually, one of the Bloomberg articles I read this morning summed it up quite well. This week we have 3 days of packed central bank action. It includes, of course, the FOMC, but also Bank of England, Swiss National Bank, not just Bank, Riksbank, also central banks from Brazil, South Africa, Turkey, Indonesia, and more. So overall, it is expected that we could see a cumulative 500 plus basis points of rate hikes this week, and there's upside risks to that as well. So it can be safely assumed that it will be a rather tough week for markets in all likelihood. On the other hand, we also have the PBOC, the Chinese Central Bank, which will likely keep interest rates steady, but let's dig into that in more details later on. Jess, I know you're watching volatility this week, and do you have any technical levels in equities maybe that our clients, our listeners should watch out for this week?
Yeah, absolutely. I think just rolling off the back of your comments, so with the Fed set to hike rates on Wednesday, followed by the Bank of Japan on England the next day, I think that we can expect some pretty big moves in either direction. And I think that market moves will be magnified by the fact that there's a lot of public holidays around the globe in a lot of markets in a lot of different jurisdictions. So this means that moves will probably be magnified in either direction because there's going to be less liquidity. So that's because, of course, in Australia and the UK, for example, there's a holiday for the Queen's funeral. So I'd be watching the volatility index, which is looking like it's probably going to extend its uptrend. So the VIX future is probably one to watch. There's a VIX option and also a VIX ETF. Which we'll put in the note. On top of that, if you do, going back to your initial question, if you have a look at the S&P 500, if the Fed does hike more than what's baked in, we know a 0.75% hike is baked in. If the Fed does move by, say, 1%, it'll likely pressure the S&P 500 and the NASDAQ lower. So the next level to watch for the S&P 500 is the level of support, which is a level lower from where it is now. That's 3,764. So that implies a 3% fall from where we are right now. And if we break below that 3764 level, then the market is likely to head back to 3,500. And that means that the market could be vulnerable of about a 14% pullback. So that is supporting those who are writing options for the downside and also are shorting the market. Also, lastly, Charu, I just wanted to make mention the MACD and the RSI. If for those of you are into technical traders, or if you're not, it's really important to be mindful that these two technical indicators are both at levels that we haven't seen since the COVID-19 crash. And we remember back in COVID-19 when these were at these levels, we then saw the market fall 30%. So lots is hanging on this week, Charu.
Absolutely. I mean, we did have, last week a hotter than expected August CPI, which, of course, the effects we've seen filter through to the markets in a big way, and we could possibly see an extension to that. We also had FedEx warning towards the end of last week, which is kind of a signal that we are in this very tough operating environment, and it's a first sign of margin pressure that could become a lot more broad-based in the Q3 earnings season. FedEx has completely withdrawn guidance. So I think that just goes to say that their internal forecasts are possibly looking extremely bad, possibly worse than what a withdrawal of guidance meant for them, which was a 20% decline in share price. So again, besides, of course, the central bank tightening, that's something to keep and watch as well. Anyway, back to the key central bank headlines for this week. Markets are now pricing in a terminal rate of around 4.4% for the Fed, which is what I think I'm particularly looking out for in the dot plot that we get out of the Fed meeting this week. My sense is that inflation and resilience in the US economy does obviously provide room for the Fed to stay aggressive, but it will still be a little bit difficult for the Fed to signal any more rate hikes than what we have priced in. I think I've seen this morning some calls for a 5% terminal rate as well. But given the kind of economic risks that this kind of a tightening could bring, I think that bar for hawkishness is relatively high here. But let's also bring in Redmond here and ask, what he's seeing in the treasury markets with respect to this FOMC meeting this week.
Hi everyone. Yeah, I mean it's the curve. After the CPI number, of course, it's initially flattening a lot and getting inverted, and really pricing in a higher chance of a 100 basis point hike, and it's if not at least 75 basis point hike, and also maybe November would be a 50 basis point. So ahead of that, we think that it's a CPI inflation in the US. Yes, indeed, it's a little bit sluggish. It's difficult to come down, especially if you look at the core component of CPI, mainly AFR from services, and which tend to be more sticky, and especially shelter, education, and medical services. Those are rather difficult to come down in very short term. So we are expecting the Fed, and in fact, it's also the ECB will become kind of a maximum hawkish in the fourth quarter. What it means is that they will be very hawkish in their statement, and also try to anchor the market's expectation, make sure to maintain the credibility, and mainly anchor market expectation of long-term inflation. And so they will talk very hawkish, and the rate hike will be high. So ahead of that, we think that in fourth quarter, we may be seeing still some room for yield to go up, and say like 50 to 70 basis point in the fourth quarter. So ahead of the FOMC, so it is probably is the risk may be high yield. But having said that, one thing I would like to bring to investors' attention is that after the significant jump in yield, and over the last 12 months, and in fact, the margin of safety for investing in bond has greatly improved. And for example, in the 5-year US Treasury, now trade yielding at 3.65, and if you buy a 5-year Treasury, even if a 5-year yield jump by another 70 basis point, and you hold the bond for 12 months, the price will come down 2.2%. But you are picking up a coupon of 3.125, 3.1/8. So basically, you were still gaining almost 1% over that 1 year. So if after FOMC, if the yield spike, and that may not be such a bad idea to look at some of the bond, especially the high grade, and high grade investment grade bond, you can probably pick up another 70 to 100 basis point above Treasury, and so that actually may be a good diversification, because of the coupon actually can help you to mitigate quite a bit of volatility in the yield in changes. But we would like to stay in the high grade, and because at the moment the corporate bond yield, the high yield, for example, in the US, the high yield is still trading just 480, 490 basis point above Treasury. And given as the economy is more heading to a recession kind of environment, in the coming month, and and also the Fed is going to tighten financial conditions significantly, and high yield spread is likely to widen. And so while the margin of safety on the high grade actually have improved, and we would rather not to position anything in the high yield, but the opportunity may arise later next years and to switch into high yield.
Great point, Redmond. So, of course, I think going into the next quarter, probably bonds will be adding some diversification to our portfolios. But also on the FX side, I think the dollar momentum has extended further last week, and there is potential for that, to extend some more into the fourth quarter. As Redmond also said that US yields could still go a little bit more higher from here. So dollar will likely remain the safe haven of choice for now. We've seen the effect of verbal intervention from the yen has faded already, and with the yield differential between the Japan and between the US widening further, we could see some more moves towards 145 in USD yen, which could of course again spark further concern from Japanese authorities and likely increase volatility in the pair. The other interesting thing is of course the euro dollar, which is stuck around parity because of the hawkish ECB as well, and risks will be magnified going into the FOMC meeting this week. Worth noting that we had a report from Bank of America's fund manager survey, which has showed that allocations to Eurozone equities have dropped to record lows, which is obviously understandable given that Europe has been the epicenter of the 2022 energy crisis. But I think important to note that this, we may be at a point where the fear of energy crisis is becoming somewhat irrational now. It is going beyond what it should be, and that can of course also signal a long-term opportunity. If some of you attended our macro seminars over the last 2 weeks, this is something our chief investment officer has also highlighted in terms of Europe of course has some short-term pains to wade through, but obviously watch out for some long-term opportunity as well out here. But again, let's jump to China as well with Redmond. We had USD CNH jump above 7, and where do we go from here? Of course, also watching China's loan prime rates this week, especially with activity data coming in stronger than expected last week. Redmond, so what are you seeing there?
Yeah, I mean, it's renminbi weekend and below this 7. I mean, it's dollar CNH went above this 7 handle, but the PBOC has done a lot and to try to use different media control to try to smooth to calm down market expectation, and saying that this 7 handle is not really a very important threshold, and because of in longer term, that is more because of the strength of the US dollar. Renminbi actually has stayed rather steady and stable versus other currency, and at the same time, there's also market report saying that SAFE is the state administration of foreign exchange, and has told companies not to speculate on FX. And so I think the pace and the speed of the move is most important. I think that the PBOC want to make it more orderly, but probably it will allow it gradually to slide and week to weaker level. So I think the next level market is watching 720, and seems that might be tested very soon, and then but 730 to 40 level probably will be a low no for PBOC in the short time, in the near term. So I think watch about 720, and but probably it may not go to 730, 40 that fast, and the PBOC may come out to calm down on that. And talking about the activity data, yes, it's strong in the industrial production as well as retail sales, and expect mainly due to auto production and also auto sales, and which it was stronger than expected, and that even we had during this kind of lockdown and also heat wave, so that was an encouraging sign. But having said that, is that the weakness still showing up in property sector. And if you look at the fixed asset investment in August, yes, I mean, it was still strong, mainly because of infrastructure. And so, but housing was actually weak. And also Friday, we also have the 770 cities new home price data released, and in the tier 1 and city new home price rose a bit, but in the second tier to the tier 4 cities all coming down quite a lot, and sequentially actually the drop was quite big. And so that's despite a lot of those kind of local government has rolled out policies and to relax home purchase restriction. And so that was a little bit worse than the market expected, and that's why you saw the Chinese property developers share price both in mainland, in Asia, and also in Hong Kong, and came down quite a bit last Friday. And also noted is Suzhou. And Suzhou actually reversed the trend and actually resumed some of the purchase restriction in 4 districts in the city. Yeah, I think that is property, the housing market continue to be some kind of a concern in China. And long prime rate, I think the market are not expecting any changes for the bank to fix the long prime rate lower. And recently there's report saying that it's the major banks has reduced the deposit rates, but that's more in response to the last cut in the LPR. And the market is not expecting any changes tomorrow on the LPR by the banks when they fix their rate.
But also we are getting some positive reports from the zero COVID front, with Chengdu probably exiting lockdown today and easing hotel quarantine restrictions in Hong Kong. So, Raymond, do you think we could witness a broader shift in zero COVID policy post that October 16th CCP meeting?
I think that's I think it's unlikely any major shift in that really still depends on the development of the COVID outbreaks. And so I don't think any reason for the Chinese government to change course after the October CCP National Congress. And anything change probably we have to come next year. So I'm not expecting any changes. But since the moment, outbreak seems is under control, and there's, yes, as you mentioned, there's encouraging news from Chengdu, and so yes, and actually the market has become less focused on the COVID situation right now unless it's deteriorate again from here.
Great. Okay, let's also, I think, probably touch Australia in more detail now. And, we have a lot of economic data, also RBA minutes due this week. But also, I know, Jess, you're watching the weather impact on commodity prices, especially, I think, food prices, wheat in particular. What could that mean for food supply, security issues in general?
Yeah, great question. So there's a lot of economic news on tap for Australia this week, and the first major release is absolutely what you said. It's the RBA's meeting minutes, and then later this week on Friday we get a really important gauge, which is our services sector reading. Of course, the services sector is critical to Australia, given that's where 70% of our GDP come from. However, yeah, the focus will be on the RBA meeting minutes, and I'm expecting the RBA to really map out their to actually hike their inflationary expectations. So previously the RBA alluded to inflation potentially capping out at just under 8%. However, now the data is in, wheat prices are rallying and they're up about 16% from August. So if you think about what that means for inflation picking up, and secondly, the coal price is again at another record high today. The coal futures price again higher. So 2 very big inflationary indicators that the RBA will be watching, and will probably be forced to up their ante with their inflationary expectations. And that could mean that the RBA has got away and ahead of itself in saying that interest rates will be on a slower path ahead. So I think this is going to be something really interesting to watch. And then if I just may touch on wheat at the minute. The wheat price is up 1.7%. and that's on the back of dry conditions in the US. Also, a downpour in Argentina, as well as frosts dampening the outlook for crops and diminishing a favorable uptick in supply coming out of South America. So a bit of supply chain concerns coming into the mix here again for wheat. Also, yeah, drier than expected conditions expected, and La Nina could potentially wreak havoc on Australia later this year. So the RBA will be keeping a lot on tow. So yeah, Charu, there's a lot to be said about inflationary expectations picking up in Australia.
That's great. And of course, I think there will be a lot of focus on commodities this week. But again, the primary focus stays on yields and, inflation outcomes. And, we have PMIs due in Australia, as Jessica mentioned, but also in Europe. Some preliminary readings for September will be coming out. Also, I think worth highlighting that gold did get hammered last week, dropped to 2.5-year lows. And if you consider the economic fallout from the CPI and the aggressive Fed rate path, a risk was also highlighted by FedEx. So while inflation, stays high, but economic momentum begins to wane, if you do consider that there is a case for some policy error by the Fed, that could be supportive for gold. So I think just keep that on your radar as well. Possibly with the dollar turning lower later this year, there it could be supportive for fresh demand in investment metals in particular. But that's it from us today. Thanks for tuning in, and have a good day, good week, everyone.
And don't forget to reach out to your RMs or your GSTs or whoever your key Saxo contact is. And thank you very much. We'll see you next week.
Bye.